And welcome. This is Mary Ellen McGonagle with your Friday afternoon MEM Edge show. And this is the show where we bring you where the action is in the broader markets. And as usual, this week, we're going to take a look and see where did the markets close for the week. And then beyond, we want to see, is there sector rotation developing, industry group rotation, and then other factors that can really help improve your trading. We want to have a good feel for what to be on the lookout for in the markets. We did have a very wobbly week at best. Of course, it was a holiday shortened period. And I'll share with you how, again, we end it today, not very constructive. And then again, we'll look beneath the surface. Also, I do want to share with you some of the more impactful headline news that did drive price action this week. And first up, earlier in the week, we did get news that the industrial side of the economy did slow down in June. This is a theme that has been in place for several months now, nothing alarming. And it actually is somewhat helpful as it relates to the concept of bringing economic growth, hence the inflation, to have it a bit more subdued. From there, we did see factory orders rise, all about transportation related stocks. I'll share some of those names with you. And then on Wednesday, we did get the release of the Federal Reserve's notes from their latest meeting. And at that point, Fed Chair Powell and other federal officials did cite that there continues to be a need to raise interest rates, and that did push the markets down a bit midweek. However, not a whole lot of surprising information in that report. It just brought back to light this concept that we could see further interest rate hikes beyond that two that are already being projected through year end. And from there, we did also get news on Wednesday from ADP, and it reported that jobs in the private sector surged, and this really brought fear into the markets. This is a key component for the Federal Reserve's inflation fighting stance. They want to see employment being reduced, hence less spending, less inflation. And from there, we did get employment numbers today for the month of June. And in fact, that did calm investors' nerves. We did see fewer jobs were created. However, wage pressures still remain in place. So at the end of this week, we did end on a rather uncertain note, not what the markets like to see. We like to see certainty. And also of note is the fact going into next week, we are going to begin earnings season. We're going to see several large money center banks, Delta Airlines, and other companies that are going to report earnings. So that is taking a look at what may drive price action next week. And then also we have very relevant inflation data due next week, and that's going to be that CPI and PPI information. And that is consumer and producer price index numbers, and not quite as closely watched as other inflation data, but it may impact the markets. And then also, a number of Federal Reserve officials are going to be speaking throughout the week. So we'll see if there's any impact from that as well. So let's go ahead and take a look at these markets and see where we close for the week. And here we are with the daily price chart of the S&P 500. And we can see that the broader markets did find support at this upward trending 10-day simple moving average. I'm going to go ahead and update this chart quite simply because this was cited earlier in the day. I did want to point out that in today's price action, we did have gains going into the mid area of the day. We did close down, and that is generally viewed as not particularly constructive. However, we also want to pay attention to these momentum indicators and where the markets may have found support. So we can see that RSI in positive territory, likewise with the stochastics. And at the end of the day, we closed just at that 10-day simple moving average. So net constructive. The broader markets were down for the week, however, but I would argue that that gives this S&P 500 an opportunity to kind of wash out the excesses when we got into this bought position here. We're still in positive territory, simply pulling back, resetting, one might say. Next week, I believe, will give us a lot more in the way of information as traders get back to their desk and really have a more, I would say, pronounced opinion. Volume was quite light this week. So there we are with the S&P 500. From here, let's go ahead and take a look at those underlying sectors. This is a 2-month daily price chart view of the 11 sectors in the S&P 500. I've gone ahead and added a relative strength indicator. The sectors are sorted in descending order, and it's not going to be necessarily really about what they did this week. It's an overall trend, and this view is really designed to help you spot sector rotation as you see these sectors potentially moving out of this stronger quartile into weaker, and then likewise weak into strength. So let's take a look here at how we closed. We did see consumer discretionary remaining up here at the forefront. A lot of this having to do with Tesla. Amazon woke up a bit this week as well, but there are other underlying sectors or areas within this discretionary sector as well that is helping. And this is all about consumer confidence on the rise, as well as retail sales numbers recently coming in quite strong. As we move forward, here we are with industrials also up here at the forefront. Now, of note is that XLY and XLI are both consumer or both cyclical areas of the market. In other words, they do outperform when the prognosis or the outlook for the economy is that we will see growth. So despite industrials pulling back, they pulled back less than the broader markets. You can see finding support at this upward trending. This is XLI, the industrial ETF, finding support at that 10-day with positive momentum. And this continues to be an area as we take a look. Buying on the pullback does serve you with this cyclical area as well as discretionary. Up here at the forefront as well, communication services. That's going to be all about Google and Meta. Meta had a great week, up 1.2% relative to the broader markets, down 1.2%. So we are seeing vibrancy in this internet-related area. And then moving forward, you can see that REIT stocks, and this is about the third week that we've seen progression. Let's go ahead and pull up a weekly here to confirm that. Nope, but it actually did have a very strong week last week, and then it was up about 0.2% relative to a negative market. Now, there are some bright spots among these real estate stocks that are beginning to emanate higher. And this particular area also fares well when the outlook for the economy is positive. So let's get back to that view, take a look at some of these other areas. You, of course, want to also be aware of these weaker sectors down here. Before we do that, I do want to share with you this view of the financial sector, which did turn positive last week, retained that positive stance with positive momentum. As we move through, I'll share with you one group that really outperformed for the week in the financials. And again, this is an area where, as it relates to earnings season next week, mostly large money center banks will be reporting their numbers. So as we move forward, I will say technology did pull back. It was one of the weaker areas. We'll get into where that weakness emanated from. Also, as we move forward, being alert that healthcare was down 2.6%. Now, biotech names were down 2%, but there were other reasons as well. News items from several large pharmaceutical with failed studies and so forth. But net healthcare is down here in negative territory below that 200-day simple moving average. So let's go ahead and move forward. We're going to take a look at some of the sub-industry groupings beyond those sectors, really helpful in formulating why particular areas may be seeing money flows into or out of. And first up this week is this yield on the 10-year. And this is pretty advanced to see this gap up and this really sharp rise. This is the yield on that 10-year treasury. We are now over 4%. Oftentimes that 4% level can really be a reason for the markets, particularly high growth stocks, to pull back. So we will see if that does in fact take shape. Most of this has to do with the Federal Reserve continuing to remind investors that we are not yet out of the woods with inflation and that we may see rates continue to rise. We can see this momentum shift here in the MACD. So keep an eye out on these yields as it relates again to those growth stocks. They tend to be quite negatively impacted. As we move forward, we can take a look at some areas in technology that pulled back. And first up here is software. IGV is the ticker symbol. The group was down almost 2%. So we want to see how it behaves at this 21-day simple moving average. We can see we had this shift in momentum with the MACD, black line down through the red at the end of June. But we still have positive momentum here with the RSI. And I will tell you, relative to interest rates, software stocks do tend to get hit the hardest if there is going to be a reaction. And quite simply, these higher growth names, their future earnings are reduced in a rising interest rate environment. So let's go ahead and move on. Take a look at another area in technology that pulled back. And this is SOXX, the Semiconductor ETF. Down 2.5%. So subscribers to my MEM Edge report will know what we are on the lookout for relative to a potential pullback beyond what we saw last week, down around 2.5% for the week. So we are staying with our names. They are holding in well, but you will want to, on a case-by-case basis with your semiconductors. And then, of course, keep your eye on the really momentum. And what to be on the lookout for also is a potential shift to the downside. But so far, we're standing in just fine. Let's go ahead and move on. Take a look at one of the strongest areas in these subgroupings, and that is bank stocks, regional banks in particular. This is KRE. The group was up 1.5%. Not really amazing, but certainly relative to a market that was down 1.2%. So we can see it's an area that is continuing to try and recover from this sharp decline when that banking crisis with SIVB was first announced back here toward the beginning of the year. And we can see we had a downtrend reversal attempt that failed, but we are back in the area of this group trying to get back into positive momentum. Kind of waffling a bit here, but I do believe that earnings will shed quite a bit in the way of light onto the health or weakness of these banks. So keeping a very close eye on this area. Also, rising interest rates can be good for banks, but it's going to have a lot to do with that yield curve, which at this time remains quite inverted. Let's take a look at some of these weaker areas. Biotech's down here, really continuing to deteriorate. This area is viewed as rather risky. Most of these companies do not have earnings, so a deterioration here can point to a risk-off environment among investors. Keep an eye on that. And then another outperformer, certainly into Friday, was energy stocks, a number of oil-related stocks on the move higher. And here we are with a look at Brent crude oil pricing up at 76.5. Not quite out of the woods yet, but the one item that was revealed this week is the fact that oil demand has remained elevated despite recessionary fears, slower economic growth talk, but this move higher in crude oil pricing did help a number of energy stocks. So from here, I'm going to go ahead and share with you a couple of, today I want to focus on base patterns and share with you what to be on the lookout for. A lot of this has to do with the markets. We're going into earnings season. You will want to be aware of what constructive chart patterns look like, what failed breakouts look like, and so on. First up here is Caterpillar Tractor. And of course, this actually Caterpillar Inc. is the name at this time. And it is very much a cyclical stock, internationally facing. I'm going to point out a base pattern formation that is talked about, but not always understood. And that is a cup with handle base breakout. And the most important note here is when you're on the lookout for this somewhat significant base pattern formation, you want to make sure that the stock, when forming the right side of the base, does not get up as high as that left side. In essence, about 2/3 from that peak in price. At that point in time, it does form what's called that handle formation, which is, I'm going to take a shot here with this. And ideally, at some point in time, we are going to be on the lookout for what's called a cup with handle base breakout if we can get up above this 251 level. From there, you're also going to want to make sure that your momentum is in positive territory. Also, ideally, you do want to see a shift in that MACD, really confirming a new uptrend taking place. Another name that we can take a look at as it relates to this cup with handle formation, this is another cyclical industrial name, and it is Flowserve, FLS. Let's go ahead and take a moment here, mark up this chart, and you can see that is going to be the top of the base forming the right side. We don't get up quite as high as that peak. And then from here, we can see that handle formation that is shaping up. Let's go ahead and take a look there. And if the stock can break above this high here, and that is at about the 37 level, so we're awfully close. The other metric that you want to pay attention to with these base cup with handle base breakouts, you want that breakout to occur on high volume. That's going to give you confidence that there could be further upside from there. Last up, let's take a look at a travel related stocks. We know that travel is still very much at the forefront for consumers, certainly here in the US. Airline stocks really continuing to power higher. This is Expedia, EXPE. And we can take a look here. I'll go ahead and mark this up. We did hit a peak back here in January. And here we are with that cup formation. From there, we can take a look at this handle. And I'll share with you that breakout level that we're on the lookout for is 113. The stock is at 112, so we're awfully close. And again, that breakout on heavy volume often will precede further upside. So I also wanted to share with you a couple of names that already experienced a cup with handle base breakout to share with you those characteristics that would signal a nice continuation rally. This is another industrial stock, Terex, TEX is the ticker symbol. Here we are with that cup formation. Go ahead with that handle. And we can see that it did break out. Now, subsequent to that, it has pulled back. We did see industrial stocks pull back last week, but at the end, that would certainly qualify as having been somewhat successful. But let's go ahead and move on because there are other items that I wanted to share with you. And this is relative to putting together a plan for when you might want to exit your stock. And this is generally going to be for traders that are short to intermediate. Longer term traders may not be as impacted by this, but really what I'm going to share with you is when stocks break below their key 50-day simple moving average, when they do so on volume, and then some of the other metrics that can really be helpful in forming your opinion and your ability to get that exit plan executed. So here we are with AEM. This is a gold stock and a couple of metrics here that I'm going to point out to you. And that is this red 50-day simple moving average. We actually have two examples. back here in February, when we broke very decisively below that 50-day, we did get relatively high volume, but also we got this negative RSI formation. We had the early signal with this black line down through the red with that momentum shift to the downside, and we can see really how much it deteriorated beyond that. Here we are more recently with AEM, break below that 50, big volume, and then the decline continues. So that is one. Certainly the other factor that really can be helpful is if you are looking at a particular stock, take a look at the industry group. And we did see gold stocks at that time did also deteriorate. So keeping that in mind. Another name on that downside protection for your stocks. Here we are with Lockheed Martin, taking us back to this end of April period. So quite simply, here's that break below that 50-day. You can see it simultaneously, RSI trending downward below that 50. And then likewise with that MACD preceding continued deterioration. In this case, it was news related. You'll also want to pay attention to that. One last name that we can take a look at here is Tootsie Roll. TR is the ticker symbol. So if we take a look at this deterioration with the stock back here in May, breaking below that 50-day negative momentum shift, this was on earnings and on the company's outlook going forward. But one other item that you can take a look at if you are inclined to get further depth with a name such as Tootsie Roll. Let's take a quick look at Hershey. Two items, actually. This stock has been deteriorating. If you were to take a look at the futures for chocolate, this is a headline item that I happen to note at this period, is that the price of chocolate has really elevated. That's going to be one component because it's a key ingredient for both of those stocks and their products. And then also take a look at that sector. Here is XLP, consumer staples, deteriorating around that same time. I did want to also share with you what to be on the lookout for when you are looking at base breakouts. Many of you may be very familiar with that. And what I'm going to share with you here are what it looks like when a base breakout fails. So we can look at a couple of names here that have just recently broken out of bases. This is Monster Beverage, MNST. Big advance here. This is in line with a number of consumer staples stocks that raced to new highs. But at this time, we did have a potential base breakout and it did fail. So if your base breakout fails, it will do so quickly. But a couple of things I did want to point out to you of note if you are looking at potentially entering a stock. For instance, during these downtrend reversal attempts, we can see that your momentum with this MACD remained negative. And we finally did get up to this period of this base breakout at 60. But again, your momentum remained negative. Eventually, once we do get that decisive RSI trending lower and a break below that 50, that's going to indicate that that base breakout did fail. One other name that we can take a look at is in the consumer cyclical areas, and that is Skechers, SKX. And we can see the same type of action taking place. Here we are. We did have this base breakout on this gap up after earnings, a brief rally, and then faltering. And it's going to be all about these momentum shifts that are going to guide you when you're looking at these stocks. Should you hold? Should you not? And then an eventual break below that 50-day. So again, for more active traders, longer term traders, if we look at an SKX on the weekly, you'll see that it's holding in just fine up here and not quite as damaged, I might say. So I also wanted to share with you the history of stocks that have a precedence where they can break below that 50-day moving average, but then recover. So this is where you're really going to want to pay attention to how your stock performs historically. So this is PCAR, PACCAR. And what I wanted to share with you here are the number of times when the stock broke below both that 50, actually that's a weekly. Let's go ahead and pull up a daily chart here, get a little more in the way of more recent price action with the stock breaking below that 50 and seemingly recovering. So that what to be on the lookout for to tell you that this pullback has in fact turned into an uptrend. What is the key difference? So I'll share with you what this more recent downtrend reversal that took place over the last month and what those metrics were that made it, defined it as a new uptrend. So here we are, first up, that black line up through the red with that MACD. And then also we did get that nice positive momentum shift on that RSI. Now we did get that back here as well, but I will share with you one other key component that really made, actually two, that made the difference with PCAR. First up here is the fact that we did experience a nice base breakout here. Let's see if I can mark that up. And here we are. So in essence, from my work, you're not going to want to be the first one in when a stock breaks back above that 50. I want to see that confirmation, in this case, signaled by a base breakout. Very nice volume, and we are getting that momentum shift with that as well. One other item to take a look at with PCAR is, let's go ahead back here. We can see that the reversal took shape here in the beginning of June. You can also take a look at the sector that that stock is a part of. And here we are with XLI, the industrials, and it pivots exactly in line with that end of May into the beginning of June. That's going to be a very key component there. And from here, let's take a look at gaps up on earnings. Again, we are going into earnings season. So I want to share with you what that looks like when you experience, your stock experiences a gap up into a base breakout after reporting earnings. This is WOR. Let's see if I can get a better view here for you and a little bit of a, yeah. So another industrial stock. Here we are with that gap up into a base breakout, nice high volume, and the stock is retaining that gap up, acting very bullishly. So that I would say is a positive base breakout. One other name in that cyclical area that also gapped up on earnings is commercial metals, CMC. We did not get that base breakout, but here is that gap up on earnings into a continuation rally. What we can do is from here, compare that to base gaps up that have not worked. And this is Carmax, KMX, came out with good numbers here, nice high volume on the gap up, positive momentum, but net, it is fizzling a bit here. And also taking a look at a bellwether name that reported June 30th. This is Nike. Actually, this is not related to that gap up. This is talking more about stocks that gap down in response to earnings. And in essence, when you see that price action, you're better served to not be involved in the stock. One other example here is General Mills, already in a deteriorating phase, but here we are with that gap down on earnings and further deterioration. And that's it for this week's video. Be sure and be on the lookout for those names that are due to report next week. We have a number of very relevant companies, and we'll see how that shapes up. Take care. Have a great weekend. I'll see you here next Friday.